Thank you, everybody, for joining us today. We really appreciate your attendance to another great Tango offering, educational offering. Today we have Ben Killey from Private Capital Group, who is going to be presenting on managing your nonprofit investment portfolio. That includes environmental, social, and governance investing, ESG, as they refer to it. Good. I don't know if I have access to move it, Rob. Great. So quick Tango Statistics. So we are up over 1,400 members. That represents over 160,000 employees in the nonprofit sector. We have 26 socially responsive partner firms, which of course Private Capital Group is among those partner groups that we have. We are primarily currently focused in 3 regions, Connecticut, Massachusetts, and Rhode Island. But I think you'll see over the next couple of months that we have big plans on expanding that into new regions and trying to attract both new members and new partners outside of just the Connecticut, Mass, Rhode Island area, with the thought that the bigger we get, the more that we can deliver in terms of services and benefits to our nonprofit members. So we really primarily focus in 3 areas: professional development and collaboration. That's what you're really participating and attending today. It's a workshop from, again, a partner with a great deal of knowledge and expertise in a specific area. These seminars are well attended. We do several of them a year, probably in upwards of 50, 60 a year of these different types of seminars. Offer networking, although that's getting a little bit more difficult in the current environment that we're in, the Zoom world that we're living in, but we continue to offer these seminars. I think we've seen better attendance. Zoom does make this a little easier to attend. You don't have to drive anywhere, and you jump on a minute before it starts and you're back to work a minute after it ends. So we really have seen good attendance through this, and we'll probably continue some version of this as the world hopefully gets back to normal. Preferred services from nonprofit specialists and organizations. So again, industry specific expertise, really working to use the leverage that Tango creates for our partners to customize business solutions and build out preferred programs to help nonprofits save money. And then goodwill and mission support, the donation depot, things like office equipment, office furniture can be donated, and we offer that out to our membership. And then the Tango Foundation, where we provide scholarships for nonprofit employees to help them further their education and hopefully grow them into nonprofit leaders someday. So the Tango Foundation, as I mentioned, it does support those rising stars. So go to our website. You can, for one, donate, but you can also recommend somebody from your organization that you feel is a rising star that you would like support in enhancing their professional development, again, and hopefully put them on track into nonprofit leadership. So these are some of our partners. Take a good look at this. We really cover a lot of different areas of services provided to your nonprofit business. Again, we recognize that our foundation, that nonprofits are complex businesses, and we've tried to build a partner network that can support those challenges that you face as a business. All of these organizations allow you to be a free member. I mean, there's no other way to put it. They pick up the bill so that you can join for free and attend events like today for free. And the only thing that these partners really ask in return is that when you're looking at your services being provided to your organization, when you come across challenges that you're facing or problems that need to be fixed, that you look to our Tango partners to help support that. And that's really sort of our ask as businesses, is that just consider us and give us the opportunity, and hopefully we're able to show you that we're the right firm for you to work with. So this is just an example of a way to flip through our partners and see what the different offerings are. This is, Private Capital Group's exclusive offering and program and the different pricing that they offer. All of our partners have one of these one-page sheets to kind of make it quick and easy for you to see what we're all about. And again, I think any business challenge that you face, any problem that you need fixed, there's most likely a Tango partner that can help support that. And really, again, that's really what we hope to get out of this as organizations, is to have you reach out to us when the time comes. So again, our business service platform, just to give you an idea of kind of the areas that we cover, benefits and risk management, IT services, HR staffing and compliance, entertainment and events, legal services, marketing and video production, government relations, investing, accounting. So we really do cover, most areas. And I will say, if you have an issue that you either have faced, are facing, that you've worked with a for-profit firm that you felt was an awesome partner, and maybe we don't cover that area, let us know. Most of our new partners come by way of recommendations from nonprofit organizations. So, we'd love to hear from you if you did work with somebody and had a great experience, and, we could certainly have a conversation with them about joining our Tango platform. And really, it's just a way for those of us that do business with your organizations every day. This is just, a way for us to give back, by doing what we do best in our specific fields. And I know for myself personally, and I know Ben well enough that he feels the same way, that it's really a rewarding way to do business. It's a fun way to do business. It's a great feeling at the end of the day when you've done something, really, really good and supported a nonprofit organization, knowing what you guys do day in and day out. So, it's a true kind of social enterprise, and we really feel like we're bringing great services to the nonprofit organization, and I think all of our Tango partners really enjoy doing it and feel good about the business that they're doing. So enough about Tango. If you are not a member, please join. And if you are a member, like I said, when the time comes, please look to Tango to help support your organization. Today we have Ben Killey from Private Capital Group. And again, Ben's going to be talking about managing your nonprofit portfolio, to include following the environmental, social, and governance investing. Ben, take it away.
Great. Thank you very much, Ryan. Joe, if you want to go to the next slide. And before we get started, I certainly encourage everybody to go to the Tango website. We've been a proud partner for the better part of 10 years since the inception. And it's a wonderful organization to tap into for resources that hopefully are valuable to you on a daily basis. Let me just start off by saying thank you to everybody for attending today. I know you have busy schedules. This pandemic has caused changes in the way we operate daily. I know some of you are struggling with grants not being the norm. Some of you maybe have greater grants because of what you're doing in the community. The reality is all of us know somebody who was on the front lines helping with the virus itself or the dissemination of the vaccines. And let's remember to give those people a great deal of gratitude for what they're doing for all of us. And seemingly Connecticut's doing a little bit better, and we'll all be safer sooner. And let's look forward to that. Quick introduction on Private Capital Group, and then go through the agenda for today. Private Capital Group was founded in 2003, a traditional wealth management firm working with high net worth investors, endowments, retirement plans. There's a natural transition of working with people who care about their community. Many of our clients sit on boards and investment committees. And so since the very beginning, we've had a significant presence in the endowment business. Private Capital Group has a little over $1 billion under management. That's notable in and of itself, but we tap into national research when it comes to investment decision making. And so we're a full-fledged wealth management firm headquartered here in West Hartford, and we thoroughly enjoy working with the nonprofit community that I'll get into a little bit more later. But we're going to talk about MIFA and the role of fiduciary, investment policy statements, endowments, and foundations, what's unique about your organizations, trends today in the industry relative to passive and active investing, and a fair amount on ESG, or environmental, social, governance investing. Formerly, it was called SRI, socially responsible investing. Today, it's even leveraged into things such as impact investing, and there's a significant amount of momentum there, so there'll be several slides on that. Next slide. So MIFA, the Uniform Prudent Management of Institutional Funds Act. Everybody might acknowledge that nonprofits are a different type of organization. There's no true ownership of the business. It's actually governed by the Attorney General, and MIFA governs those rules and legislation. And everybody who touches an endowment type asset, whether sitting on an investment committee, a consultant, really has to abide by these rules. At the end of this presentation, which we'll email out to everybody, are 13 very salient points about UPMIFA, but just recognize that you do have a fiduciary responsibility relative to this rule. And as much as there's a board involved with most nonprofits, the Attorney General actually follows through on these to make sure you're abiding by this criteria. So next slide. Role of a fiduciary, just simple at the top, acting on behalf of others. You can't have conflicts of interest. Everything you do must be in the organization's best interest. Provide full disclosure. If you think you have a conflict of interest, you recuse yourself from any voting. Always acting in good faith. Constant oversight of these assets under management. They have to be aligned with your mission and objectives, and everybody must adhere to the highest ethical standards. Probably common sense, but sometimes there's situations where you actually want to follow these rules. But if everybody understands you're a fiduciary, and there's very specific rules regarding that. Next slide. The basics of any good endowment is to definitively have an investment policy statement. It's governed in UPMIFA, and it could be 1 page, it could be 15 pages, but to have one is critical. It allows you to follow a protocol that's documented. Some of the things that you start out with is, what is the mission of this foundation asset? It's definitively there to support the organization. It should be articulated at the top of an investment policy statement. You want to obviously recognize that this portfolio is for the long-term growth of the organization to preserve its existence into the future. There's risk profiles, time horizons. Those time horizons are usually in perpetuity or indefinitely, but there could be a time horizon for a building project that has a shorter horizon. There usually is liquidity needs where you have ongoing operations and monthly outflows. That money shouldn't be invested for the long term. And then you usually want to stipulate some type of return expectation, something in the neighborhood of inflation plus 3%. We're going to get into the investment consultant duties and responsibilities, portfolio selection guidelines. At the very basics, people want to identify how much they should have in equity or stocks versus fixed income bonds. And then this alternative asset class, which could be real estate, commodities, currency exchange, private equity. And then it should be articulated, how often do you rebalance the portfolio? Since asset allocation is the most critical component of risk and return, there should be some identification of how often you rebalance the portfolio. At least annually, some are more routine on a quarterly basis. And then performance monitoring. It's critical to make sure you're measuring the performance of your portfolio against a peer group, against benchmarks, and then also the terms of any agreements that you're entering into with consultants or investment managers. What is the ability to terminate for whatever reason that you see fit? The next slide. So investment governance and operational framework for larger organizations, the eligibility for serving, you certainly want to have the CEO, the CFO, the executive director. You want to have peers from outside as volunteers who are near and dear to the organization, but that should be articulated how big the committee should be, who should be on it. And you definitely want people with diverse backgrounds. Some people lack financial knowledge, but they certainly understand the mission of the organization better than others. And you want a mix of people. There should be a chairman identified who can utilize Robert's Rules of Order and take voting, and somebody taking notes so that you can approve the prior meeting notes at your meeting. All of these are critical for really administering a foundation and assets in the right way. You'd want to identify the roles for consultants and the frequency of your meetings. A simple charter that talks about the eligibility, who should roll on in 3 years and off, and different people in specific roles is a good tool to bring out and say, okay, we now need to add a new member. They've exceeded the duration on the committee, and it just has a nice flow of getting new people in and involved with the endowment assets. Next slide. So the role of an investment professional in UPMIFA clearly articulates that one probably should seek outside guidance for assets of this nature. simply because it's complicated and it absolves a certain amount of fiduciary responsibility when you use an outside professional. But these are the basics of anybody acting as an investment professional. Want to start with asset allocation, risk and return. How should a portfolio be constructed? Should you use mutual funds, exchange traded funds, separate accounts? What is the manager's selection process of the people who are actually calling the shots on which stocks or bonds to buy? What should the performance reporting look like today based on technology? Daily performance reporting is pretty readily available, but at the very least, you should have quarterly reports that articulate how well your portfolio is doing, basically in a hand ready to report to the board or the investment committee at will. Administrative support, there's always money flowing in and out of these portfolios to the extent that somebody can easily transfer money to and from bank accounts. Make sure that when committee members change that are in authoritative positions, new signatures are on the investment accounts. And then the custodial services are who delivers the monthly statements. That could be the Fidelity, the Schwab, the Merrill Lynches of the world. They provide a service that safeguards your assets. And then, as I mentioned earlier, the trading and rebalance should be identified and carried out largely by an organization that has the skill set to properly do it. An investment professional should be educating everybody on the committee about asset allocation, risk and return, volatility in markets. And that's a good thing to have happening on routine meetings. Next slide. So really, when you're looking at, there's two major ways to seek the guidance of outside experts. One is a consultant, where the consultant would deliver various investment management options and the committee would approve, and then they would go back and get that implemented. For some larger organizations, they outsource it to a chief investment officer. It's OCIO, where that chief investment officer does not have to take a vote to approve any changes of the management. You've delegated that authority to a chief investment officer, and they just do it on your behalf. So much more control when you outsource the chief investment officer. And this tends to be in larger organizations where sometimes it's not as easy to get people together and the dollars are bigger. And they do a national search and select a chief investment officer that's outsourced. Next page. Now we're getting into, how should you actually allow money to be dispersed via spending policy out of the foundation? And there are certain things that you can't exceed, and there are proper ways to do it. But the end goal is to deliver some money from this portfolio, perhaps on a monthly or annual basis, without compromising the principal. These foundations are typically set up to support the organization for decades or indefinitely. So you don't want to jeopardize the intent of the portfolio by spending too much too early. So typically there are spending policies at the bottom outlined. The second one is probably the most frequently used. Percentage of the portfolio is smoothing term. If you think about the financial crisis, 12 years ago, the market's off 40 to 50%. If you were just looking at the prior year, you would have a significantly less draw. So percentage of the portfolio over a smoothing term might be something like 4% of the portfolio for the average of the last 20 quarters, which is 5 years. Sometimes we see 3 years, and there's combinations with inflation and fixed dollar amounts. When your organization is budgeting for future years, it's nice to know a pretty good idea of how much is coming out of these portfolios that you can expect, so that you can talk internally about what you can afford to do or new things you can afford to do, or if the market's down, how far down might your operating budget need to be adjusted. And via UPMIFA, that criteria is never exceed 7%. I'm going to say that in most endowments, it's somewhere around 4%, and some endowments are lowering that to 3%, just given that the market outlook over the next 10 years may not be as good as the last 10 years. So anywhere in that 3 to 4%, if you're in the 5 or 6%, it's probably a bit high relative to future expectations of the stock market. Next slide. So when you receive donations, the donor intent is critical to understand, whether it's just to go in and support the operations or whether it's to support a specific cause. The donor has to put things in writing in order for it to be legitimate. So if they're intending for it to support a specific cause, it behooves you to get it in writing. You don't want somebody coming back and just saying verbally, I told you I wanted it to be spent only on this specific area. But once that donor intent is identified and it's very specific, then it takes on ownership of the organization to monitor that and make sure that their intentions are upheld. And so you would, I think in most cases, like to receive unrestricted donations, just goes into the portfolio, and then it's up to the board and the organization to determine how it's spent. But keeping the donor intent is critical to abide by the rules. Once you have the donor intent, there are definitely a few different ways to administer it. Certainly have accounts where there's board restricted, donor restricted, unrestricted accounts. There's many different ways to administer it. And the whole idea is to keep things as simple in your organization. If you have multiple accounts, you go to the next slide, Rob, please. So in the middle there, separate investment accounts, it's easier. You have the label on the account, you know what it's for, but sometimes you might end up with 10 different accounts and if you do it that way. So another alternative is to just pool all of the money, and internally you're keeping track of what percent is for which specific cause. It's easier to administer one investment account, but it puts more ownership on the organization to identify what portion is board restricted, donor restricted, or for a specific cause within the organization. Next slide. Portfolio construction, this is where you get into what types of investments, but the pure basics is how much do you have in equities or stocks versus bonds? And that's going to dictate the amount of risk and return that you get. So going through that process early on, understanding the role of this portfolio for the long term is critical to its success. And then there are different vehicles. Separate accounts are a basket of individual stocks. And what that allows you to do when you can see the underlying stocks, some organizations would like to have a customized overlay. It could be for Catholic values. Here in the state of Connecticut, certain endowments said they want to avoid gun stocks, gun manufacturers, simply because Sandy Hook was near and dear and front and center to us. It could be avoiding fossil fuel stocks. Unified managed accounts are just a combination of multiple separate accounts. And then frequently there are exchange traded funds, which are largely passive indexes, mutual funds, and a combination of mutual funds and exchange traded funds as fund strategies. So all these vehicles are utilized routinely in the endowment circles. They have different functionality and customizable features, but those are the most notable ability to diversify a portfolio. And then at the bottom, the larger your portfolio gets, the 5, 10, 15, $25 million, things like private equity, currency exchange funds, real estate, different asset classes can be considered. At the bottom, all expenses, keeping it reasonable. If you consider every single fee applicable to a portfolio, and the larger the portfolio, the lower it should be. But if you're in that 0.5% to 1%, considering every fee applicable to a portfolio, it shouldn't be exceeding 1%. And again, larger organizations can get those fees down significantly. But that's taking into account investment manager fees, investment consulting fees, reporting fees, transaction fees. And it takes a bit of work to calculate those, add them all up. But again, a drag on the portfolio is certainly attributed to fees, and you want to pay attention to those. Next, I know this is a busy chart, and to the extent that you could just let your eyes glance at the dotted line that goes throughout it, that is a 60-40 investment portfolio. It's not trying to be a home run hitter with 100% in the stocks. And so it's never at the top and it's never at the bottom. But all these other colors, many of them end up at the top one year and the bottom another year, and you're chasing the best return, often going in the wrong direction. Over to the right-hand side, the second column from the right, is the annualized return for the last 15 years. And you can see that that asset allocation portfolio in the gray is 6.7%. And that doesn't sound as good as 8 or 9% in stocks, but relative to cash, which is the second from the bottom at 1.2%, you've gotten 5 percentage points greater than if you park the money in the banks, and 5% per year greater on millions of dollars allows the organization to have a greater balance to support the greater good in the community. So it behooves you to have a diversified portfolio and think about it being diversified and not trying to be the big winner and maybe being the loser by chasing different elements of the stock market year by year. And this would be a sample of a good target asset allocation. Right in the middle, it says strategic allocation, 60% in stocks, and that's a combination of both US and international. And then 40% in bonds, again, diversified in bonds. And over to the right, you could set lower limits and upper limits. So it gives the investment committee some flexibility given what's happening in the market and volatility, that the committee has some leeway to either reduce it down to 50 or up to 70. And those are good ranges to allow some flexibility of different perspectives from investment committee members. But it then restricts the committee from going all to cash or all to bonds. There's a set of protocol. It's in the investment policy statement. And it's something that people can refer back to say, we have this flexibility in our document, and maybe avoid some types of conversations about market timing and moving all in or out, all out, staying with a strategy. It also sets the tone for rebalancing when you have this strategic asset allocation. It's a framework, and it's an easy decision to hold true to the risk and the return profile of the portfolio. Moving on, measurement and monitoring. I mean, you always want to measure and monitor your success or identify where things aren't working. So again, I mentioned earlier, frequency of review definitely should be at least annually, but more frequently it's on a quarterly basis. And a good capability would be to have your performance monitored daily with an outside consultant. So at any given time, because meetings don't happen on a structured quarterly basis with a calendar. So to be able to pull up a report and say, through yesterday, this is how our portfolio performed, is helpful to engage the committee in a timely basis. You want to make sure your managers are performing relative to an applicable benchmark, making sure that their upside, downside capture ratios and risk relative to the market, meaning that they're not overly volatile. And then instead of trying to chase and be in the best 10% of the investment spectrum, if you're routinely in the top 50% compared to peers and you stay there, you'll be in one of the better long-term performing funds. So stay away from seeking out somebody who just performed the best last year and decide to jump on the bandwagon. In your upper half on a routine basis, longer term, you'll end up with one of the best performers longer term. How long should you look at an underperforming manager? Any manager can have a bad quarter. Their theme takes time to play out. So they may make some investment decisions that take 6 months or a year to play out. But if you're looking at a 3-year horizon and we've gone through some type of market cycle and the manager has not performed up to expectations based on returns or risk or volatility, they may have excessive turnover within their organization. They may have outflows. So 3 years is a bit long. So anywhere, from 1 to 3 years is to making sure the manager is performing up to expectations is advisable. Next slide, Rob. So again, just to rehash kind of an optimal portfolio process, it starts at the top with your goals and analysis with a very good investment policy. That leads you to a defined asset allocation, how much in stocks versus bonds or alternative assets. And then your portfolio construction, is it diversified? Is it passive, active? What are your implementation options? That's mutual funds, exchange traded funds, separate accounts. And then you have your routine risk and performance monitoring. And it leads you right back to the top where you at least have an annual review to make sure your goals and investment policy are in check. Next slide. So this is worth noting because, you always want to think about the downside, and it wasn't that long ago the stock market did sell off in the financial crisis 50%. In the pandemic, it sold off 30%. It recovered quickly. But if you did lose 40% of your asset value, this is how long it takes to get to break even. And the 11% per year would take 6 years to get back to break even. If you achieve 7% annual returns, it would take you 10 years to get back to break even. So this just puts an onus on the organization to pay attention to downside risk, because it could take a long time to get back to break even based on how far you go down. If you lose 50%, you have to earn 100% to get back to break even, just with the math. So protecting your downside, using your fiduciary responsibility is very important. When it comes to foundation assets and endowments, they aren't your personal assets. So protecting the downside is critical. Next slide. So we had one notable change on this where we had just mixed up something. So this is passive versus active investing. Passive is index investing where you're very diversified. All right. So at the top under passive where it says potential for higher returns, that should be at the bottom under active, and we'll get that straightened out before we email this out. A pro for passive is that it's much lower cost. It's just running an index. It tracks the S&P 500 as the top 500 stocks. Nobody's doing any active management, so it's much lower cost. And with a click of a button, if you can buy 500 stocks with one little click of an investment, you get enhanced diversification. And a pro for passive is you're going to get the stock market return. There's no tracking error. Some of the cons for passive investing at the top is you're not going to get out performance. You're going to get what the index says you're going to get. So you're not going to achieve higher rates of return. In today's environment with hedge funds trading, there's a high volume of trading in these indexes. And so the volatility can happen fairly quickly if there isn't a wide base of ownership of these indexes. Can't customize an index. It is what it is. There's no ability to look under the hood and change anything. It tracks the S&P 500 is one that I'm making mention, but there's hundreds of indexes. And then at the bottom for active management, there is a potential for higher returns. You're looking for a manager that's going to outperform the index. There are hedging strategies with active managers where they can attempt to reduce your downside risk. There are shorter term opportunities to play on perhaps what's happening with green energy today. There's specific funds that will play into that. A con for active is that because they're not just tracking a basket of stocks as an index, there's managers, there's research, there's analysts. They are more expensive. Another con is you can miss the mark with an active manager and they can have what's called high tracking error, meaning they didn't meet the benchmark, they were lower than the benchmark, their theme didn't play out. And then a con for active management is there can be manager turnover. They could either leave, get fired, retire, and that person that was head of that particular strategy is no longer the person in charge today. So you have to monitor who's actually managing the money and is that person still there that generated the track record previously. There's been a massive shift over the last 10 years to passive investing because it is lower cost, because it is diversified, because it's been very difficult for active managers to outperform passive strategies. So large pensions, large 401ks, there's been a huge shift. We believe there's a combination of the two that makes the most sense. And next slide. So historically, and this elevates over to the right, the green line is the passive strategies and how much growth there's been in that category, but it hasn't always been that way. In the 2000s, active managers outperformed passive, but going forward, I think you're going to see the combination much more applicable to portfolio strategies. Next slide. So now we're going to talk a little bit about the investment trends in the industry, and we've talked about ESG investments, and there are certainly some myths. There's momentum. You're going to see that there's a tremendous amount of interest in this area. And even if none of the organizations on this call actually implement it, the fact that you would talk about it in an investment committee, document that you've talked about it, but there are good reason to consider ESG investing in your portfolios. Next slide. So if we put you right at the center, being the client, and talk about performance and values, you're looking to align your portfolio with your specific values. It could be global climate change, it could be low-income housing, it could be healthcare. There's so many different areas that are applicable to your values that you align your portfolio, you integrate these factors, and you allocate your investments. And you're going to see in future slides that there's a tremendous amount of implementation taking place in this area today. Next slide. So again, and you're going to get this handout, but align, integrate, allocate. You know, in the middle, if you're integrating, you're looking for a portfolio. You know, if you think about, banks, and you think about Wells Fargo, you know, a couple of years ago had all kinds of issues with promoting credit cards that people didn't actually sign up for. They were fined. You're looking to integrate companies that are doing the things that you'd like to integrate within a portfolio and avoid the problematic companies, and allocating things across different sectors so that you are abiding by the principles that were set out to begin with. Next slide. It used to be on the left-hand side that you would just go through and exclude the most common ones, 10, 15 years ago, or, let's exclude alcohol and tobacco from our portfolios. It's expanded today to include things like adult entertainment, firearms, gambling. But the idea today is to maybe look at companies that are best in class about some of these areas, the companies that are administering their capabilities to reduce their carbon footprint across all spectrums of their delivery of a multinational global company. And then over to the right, just recognizing our society and different elements. It's global climate change. It's looking at boards, whether there's representation by women, by minorities. Do they have equal pay across their base of employment? And then what are these organizations doing in their communities to benefit their communities? So all of these are measuring sticks today that just about every publicly held company is abiding by this criterion, being measured, and some do a better job than others. And it's been identified that if these organizations are paying attention to, as an example, their carbon footprint, they're monitoring how much shelf space their products take on a shelf, how much storage it takes in the trucking, how they're packaging their goods, and they're looking to reduce their carbon footprint across all delivery mechanisms. So again, everything is being measured. It's getting better and better by the year to identify good companies versus bad companies. Next slide. So some of the myths, on the left-hand side is that this might be a fad. You're going to see the momentum in a couple of other slides. It's not a fad. You're going to see that it doesn't hurt your financial performance. And in fact, it might even help it a little bit. And, the environment does not affect investors. Everything is affecting investors. There's going to be global shifts if we don't promptly address global climate change, where people live, where it's getting too hot, where they can't grow things, where water might rise. It's definitely affecting companies and locations and everything that we're doing, from the cars we may buy in the future, but it definitely is impacting portfolios on an ongoing basis. Next slide. So this is where we start to talk about the interest. On the left-hand side, I mentioned that companies are disclosing information. 10 years or 20 years ago, 10 years ago, 20% of the companies were abiding by some of this ESG information. Now, 86% of publicly held companies are reporting ESG information. Institutions are investing based on ESG criteria, and clients, perhaps yourselves and just the traditional clients, 72% of clients are asking about their portfolios and how they can be aligned with some of their convictions. Next slide. So this is the universe of investments that are available that talk about being sustainable investments, impact investments, ESG. And you can just see the tremendous growth from 2015, 5 years ago, to today. There's almost 3 times as many investment options. And it's because people are demanding those options and they want to invest with their convictions. Next slide. It doesn't just apply to the stock market. There are green bonds. The Apples of the world come out with bond offerings to build new facilities that are deemed to be green with LED lighting and capabilities. So all of this is applying to not only the stock market, but the bond market as well. So it's easy to build out portfolios that are applicable to ESG criteria. Next slide. So one of the fastest growing segments on the left-hand side is 2012. And it should be noted that Europe in particular is far more progressive at ESG investing than the US. They started it, whether it was avoiding fossil fuel investing in geothermal and solar and wind. They have been investing in a socially responsible way far earlier and bigger than the US. But in 2018, just 6 years later, you can see that the US market quadrupled in this type of investing and Europe almost doubled. So there is, again, huge growth. And the Biden administration obviously coming out with green energy initiatives and supporting infrastructure and alternative energy. There's intended to be even greater momentum in this category. Next slide. This is talking about performance, and this is dating back 30 years. There's an index called the MSCI KLD Social Index, and it's looking at companies that abide by the social criteria that I've been going through. And it's the longest running index, and you can see that you haven't given up a return in these 400 socially responsible companies versus the S&P 500. And the S&P 500 has been one of the best places to be for this duration. And you could say that these returns are nearly equal, but it's an indication that you don't have to sacrifice long-term rates of return in order to get the type of performance that you'd be looking for. Next slide. This is a shorter time frame, just taking a 5-year snapshot, but it includes some volatility characteristics. This is a traditional 60-40 portfolio. And you can see that the return on the right for the annualized return of a balanced portfolio with ESG criteria slightly outperformed. It adds value over time. So again, looking at different time frames, you could come to a similar conclusion that you're not going to sacrifice rates of return by investing with your convictions across these specific categories. Next slide. As much as you see this momentum, this is an indication that while millennials on the far left are talking about a great deal and they're impacting the endowments at colleges, they're going in and talking about global climate change and asking that those endowment portfolios be fossil fuel free. Females talk about it more so, just be more caring and cognizant of society and the things that are around us. But what is disappointing is that the advisors that are traditional in the business are still stuck a little bit in the mindset of, hey, you'd have to sacrifice a rate of return. Just take your profits and invest it in your community and in your initiatives. So advisors aren't today aligned as much with what the interest is. So if you're talking to somebody, you might have to push on them to say, hey, this is of interest to us, and what are your resources? The advisor community hasn't caught on as much as it has by people's preferences. And then, seeking this out, it really is impactful if you can sit back and understand that your portfolio is much more aligned with your values people are much more satisfied with their investment portfolio to know that they're having an impact in whatever area it is. It could be global climate change, it could be avoiding guns, it could be alcohol, tobacco. You're much happier with your portfolio. And so to get a portfolio that reflects the true intentions of the beliefs of the organization, the mission, the values, just is a feel good, and also the returns are commensurate with the risk. And then the future of ESG investing, just looking forward, another 4 or 5 years, you can see the tremendous growth that's expected. And it is one of those greater growth areas in our industry. It's talked about daily. There are things hitting our inboxes daily about ESG investing. There are new avenues being pursued about it. There's new criteria. The United Nations has very strict 17 points that come out that they would like to have followed to be ESG. So everybody is paying attention to this because it makes sense. The profits are there, and investing with your moral convictions can add value to the portfolio. So expect to see greater growth there. That's why I've spent a fair amount of time talking about it today, is that it's out there, it's being utilized more, it's being talked about more. And at your organization, again, even if you don't implement it, you could at least say you're aware of it, you're considering it, you're watching it, because there is such tremendous momentum in this area today. Next slide. So this is, it's kind of rapid fire today, but just takeaways. Your role as a fiduciary, understanding of MIFA, which is the appendix to this, and knowing your role on an ongoing basis is very important to understanding and making sure that you don't run afoul of the rules. Nonprofits are very different, and your fiduciary responsibility is critical. Having that investment governance and operational framework of knowing who should be on the committees, what their duration is, what their titles are, who the chairperson is, and then following an investment policy statement, either having one crafted, approved. Larger organizations tend to have greater details with maybe 10 pages. Smaller organizations might have 1 or 2 pages, but it's still critical to have an investment policy statement to go back to govern how the investments are managed. And then I mentioned passive versus active investing. The passive has attributes of greater diversification, lower cost. Those two things are important in any portfolio. And then you can complement that with some active investing in specific categories where you would expect a manager to outperform. Those two combinations are being widely utilized in endowments and foundations. And I suspect many of you have some of that today, but it's two major differences. Both of them have merit. And then the trends in the industry are to understand that there's impact investing, and it's critical to kind of identify what's important to you and then align a portfolio. A good advisory firm is going to be adept at that. They can guide you into the right way, utilizing the right structure, keeping the expenses low or reasonable. And so we at Private Capital are doing this work. We truly appreciate working with the nonprofit community. It's energizing and inspiring to get into those investment committees and understand the mission and the true impact that you're having in the community. And we feel privileged to work with your organizations. We would appreciate the opportunity to engage in any conversation about how your portfolio is structured, what the current expenses are, what the diversification is. And so we're here to support you in what you're doing out in the community, and we would look forward to that opportunity. I think on the next slide, there might be some question and answer at this point. If anybody has a question, they could go off mute and certainly ask away. Well, look, I truly appreciate everybody taking an hour out of your day. I hope you got some value out of it. And please, on the next slide, and you'll have it in your inbox. If you'd like to reach out, we'll probably send out a thank you. Please respond, and we're happy to engage at any time. And best wishes to everybody in your respective endeavors in dealing with this pandemic crisis. And thank you again to anybody who may be on the front line or anywhere associated with you. We appreciate what you're doing.